Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for Beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking ANZ Group, ASX code, ANZ. How are you, Elio, and why a bank?
G'day, Phil. Yeah, no one needs to adjust their headset. I think we are going to talk about the right company, and that's the ANZ Group. And I think, just to highlight that we are investor agnostic in regards to we don't stand on a pulpit, profess to know the meaning of life, universe, and everything. In fact, I know people who barely have the IQ to tie their shoelaces who have been successful in the share market. So who am I to sit there and say that they're wrong? All we want to do is just give great information to everyone. And I think it's a great question. Why a bank? Phil, I think we start from there and go there because, I read an article that was in the Australian Financial Review the other day from the fine people at Chanticleer, which was basically saying that CBA at $132, no one's recommending it to buy, yet someone is buying it because, of course, being a market, that's what happens because the price is up there and it's been our best performing bank for the last 12 months. So that got me thinking in regards to the Stockopedia's metrics and how we look at the universe, which of the four banks would actually be most attractive at the moment. And that die actually fell on the ANZ Group, which when you compare each of the four side by side, it actually ranks highest, which is interesting. Because over the last 12 months, it ranks, I suppose its price performance, though positive, even though it's at 52-week highs, is actually lower than the other three of the big four. So there could be an opportunity for investors here in this stock, which is often overlooked, but I think unfairly so because it does have some good metrics.
You've been in the market for a while. What do you think's going on? Because every analyst is saying sell or just get rid of CBA. Whatever the message is, don't keep buying it, but someone keeps on buying CBA. Why do you think that is? Where do you think the money's coming from?
It's an interesting one. I think if you rethink the way you conceptualize banks, it definitely helps with the visioning of this, Phil. In my view, as has always been the case, and our members know, is that banks in total are really a barometer of the health of the overall economy. Now, notwithstanding that there will be periods of outperformance, underperformance, and squiggly lines doing what they do, ultimately, if you believe that the Australian economy in 10 years' time will be bigger than where it is today, then really you have to be long the banks, irrespective of whether you're paying a couple cents over or a bit under or whatever the case may be. They're big. They're well capitalised. They're generating strong levels of cash. And yes, of course, all those term deposit refugees will be happy with the fact that they've been paying a good yield for quite some time. So when you look at CBA, you aren't actually betting on the company, as it were. You are betting on the economy. And I'm still yet to really come up against anyone that's been able to convince me that the Australian economy is going to be short or, I suppose, smaller over the next decade. Now, of course, I've had people who have said that it's not a buy now or sell or whatever. That's just analysts doing what it is that analysts got to get paid to do. But if you stick your head out the window and actually look at the weather for a change rather than, some pretty person on TV telling you, then really what you're looking at with banks is what our economy is doing at the moment. And COVID aside, we've been doing pretty well. We could be doing better, of course, and some might say we could be even doing worse. But ultimately, I think as a whole, we've been doing okay, and you've seen that reflected in bank performance. So investors who think our economy is going to keep growing, then they're going to be in the banks. And of course, because they make up such a large part of our index, you then also have the rise of ETFs, exchange-traded funds, as they say in the vernacular there, which obviously have seen a large amount of money come into these stocks. Even if you don't like them, you still got to take a position in them. And then there's even fund managers who have what we call active bets. So, for example, if, someone like an ANZ is currently eighth largest in the market, has a market cap of around or close to $90 billion. Now, you might be only accounting for, I don't know, let's just say 2% of the market. You might actually not necessarily think that it's going to do well. So rather than taking a 2% holding, you actually still buy it, but you just take a 1% holding. So even though you do, suffer underperformance, that ain't that bad, because your active bet, as it were, is that it is down, but you do have some to insulate you on the way up, as we've seen with a number of these businesses. So long story short, Phil, there's a stack of reasons why banks are elevated at the moment. In my view, I think it's a sign of going long Australia, and I'm long Australia, and hence why banks have been a cornerstone of many DIY self-managed super funds for quite some time, paying a good yield, and now at the moment offering some good capital growth.
I love your patriotism, Elio. Just a little sidebar here, and I'm an amateur in these matters, but I have heard that overseas investors, and especially the large institutional investors, when they buy anything in the Australian market, if they're going to buy a bank, they're not going to buy any other bank apart from the Commonwealth Bank. Right. And we've seen in the United States where a lot of the money's being rotating into smaller caps recently. Is that dynamic at play here at all, do you think?
Look, to a certain degree, I mean, let's face it, CBA out of the four has actually done the best over the last 12 months. However, when you go out a little further, notwithstanding periods of over-enthusiasm and over-pessimism, the four generally move in a similar sort of direction in a similar sort of way. They all have the same challenges, of course, and the same excitements. And overseas investors, when they look at little old Oz, notwithstanding we're I think the eighth largest exchange of the world or something like that sort of thing. We punch above our weight nonetheless. But even though we do that, we have a massive tail, this huge tail. I mean, materials is our largest sector. It's mainly made up of rats and mice types of businesses who really don't command serious capital in them. And because of that, many overseas investors do shun those types of stocks. But that ain't the case with CBA. Like I said, well capitalized, low debt, generating those solid returns, paying a good dividend, even though they can't benefit from franking credits, as it were. They're still, generating quite some solid returns. And effectively, as I've kept alluding to now, that exposure to that Australian economy, which is what CBA is. So definitely, Phil, you will see overseas investors be attracted to CBA because unlike our big miners, like a BHP or Rio, for example, whose direction in price a large part of the commodities they're involved in will have a big say in where the price of that particular or those particular stocks go. With regards to CBA, it tends to be more of a stable, predictable, dare I say it, in regards to cash flow and earnings. Although, as an aside, they were complaining that net interest margins have been reducing, as they have been for all the banks, and they're all saying it's because of increased competition. Well, look at the other side of the ledger. You only get increased competition when your sector's doing really, really well. If it was doing really poorly, ain't going to be no one getting involved in that space. So when you see increased competition coming into the sector, that's generally a good sign for the overall sector as a whole. So things are flying in regards to these businesses. Overseas investors want that. That's why they go to CBA. But I think domestic investors who can broaden their universe can look for periods of, some opportunity, as it were, from that over pessimism type of perspective. And in our view, ANZ offers that at the moment. And it's not really our view. It's basically just looking at the numbers and assessing each on those benchmarks and coming up with the overall result.
So, ANZ, are we finally talking a company that's got a good value score?
You've nailed it. There, of the four banks, value is where it ranks the highest. So it comes up with a ranking score of 82 from a value perspective, which, of course, isn't 100. So it's not the cheapest stock on the ASX, but it's in the top 20%, which would suggest to you that on a pure value metrics, that you are looking at, possibly a relatively cheaper business at the moment, notwithstanding the fact that obviously it's underperformed in terms of price relative to the others, and notwithstanding that it is at 52-week highs as we speak, and that they've got increased competition, blah, 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 blah. From a value metrics perspective, where you look at things like PE, dividend yield, for example, if my memory serves me correct, I think it actually pays the highest forecast dividend yield of all the four. There's really not much to fault in regards to its value. And I think if you're looking for the cheapest bank at the moment, the ANZ is probably sitting sweet in regards to that perspective, and hence why it's received. I mean, things like price to book, for example, only 1.2 times, price to sales only 4.1 times. Just looking here, the yield or the estimated yield is almost close to 6%. So notwithstanding our interest rate rises, we are still paying above the free cash rate, as it were, as provided by the RBA. And it's on an earnings yield of 8 times. So again, notwithstanding that competition, it is the cheapest of all the others. And the fact that prices underperform the others does create that opportunity that perhaps investors may be looking for.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB.
Is there still a 4 pillars policy? I remember we're old enough to remember the 90s and Paul Keating putting in the 4 pillars policy that we were going to have 4 big banks. Has that increased competition now because of some of the credit unions that have become banks and Bank of Queensland and all of the others, Bendigo and so forth? Is the 4 pillars policy not what it used to be?
Yeah, in regards to itself, no, it's not. I mean, governments for quite a while now have been trying to instigate some, arrival from overseas participants. Probably the most successful, if I can say it, is Macquarie Group, which is probably sitting there and close to almost being one of the 5, as it were, rather than the 4 pillars, as you say. But I think it's important to remember that banking isn't just about transaction. I mean, we know all that money that was spent on open banking in order to ensure that the customer data was able to be ported quite easily between one and the other, effectively allowing us the ultimate choice. But it dismissed the biggest and most immediate thing that many investors have, which is trust. And assuming that you haven't been burnt personally by a particular provider, we sort of all accept the fact that they're going to be walking the wire with regards to where they position their business and their messaging and the like. And therefore, provided it doesn't affect us personally, as it were, we tend to just accept that they're still going to be relatively sound. Now, this is no fault of the government. This is just human nature. Now, of course, they talk of increased competition, and let's face it, when it comes to getting a cheaper home loan or anything that costs us money, of course, we're going to be particularly interested in that, especially as our information is now far more portable and the like. And yes, the emergence of those credit ratings into banks, as you say, the emergence of a lot of those regionals, as it were, coming from their agricultural space and various other sort of machinations through to more traditional banking style operations, and the strength of the property market, both at a residential, well, particularly at a residential level, but also at commercial and the like. All of those factors combined assist with regards to banks, but it doesn't necessarily shake the big 4. There will be periods of outperformance and underperformance, like in things like business banking and the like. But really, at the end of the day, if you trust the institution you're dealing with, irrespective of whether you save a 0.1, 0.2, or whatever the case may be, once you are a client, you tend to be a client for life. And then that's more than one product. There are auxiliary products that flow from that and end up serving clients like that. So, yeah, notwithstanding things like royal commissions and the like, we are still very much in a 4 pillars type of structure. And though we are soon seeing a 5th pillar approach, it's still basically the Australian market, as it were. And it's the same with any sector and industry that's out there. There are peculiarities with regards to Australia, and trust is such a big one of those.
So you've run through a few numbers previously in the interview. Is there any other parts of the financials that you wanted to look at and share with listeners?
Look, I do want to emphasise the fact that it is the smaller of the, let's call it the big four, as it were. ANZ from a EV perspective, which includes the cash they have on hand, which you really can't, well, it's a bit awkward to look at, and this is in the accounting and the like, but there's around $120 billion worth sitting in there. From a market cap perspective, though, it's actually the smallest. It rates at about $90 billion, yet when you look at sales, at $21.5 billion, it was actually close to Westpac, and it outpaced the NAB. So this further adds to that value argument that was being said before, if you're looking at them at a pure metrics perspective. And the fact that it's on a rolling PE of something like 13 times, I don't think that would make Ben Graham turn over in his grave, as it were, notwithstanding it's probably more than he'd like to pay. Again, it is cheaper of the big four. So again, you are looking at one of those businesses where there may very well be a bit of an opportunity there in that regard. And I alluded to the fact that the dividend yield was the highest of the big four. And even though I suppose, yes, you touched on it earlier with regards to CBA, because it has the best return on capital employed, the best return on equity, it also has the best operating margin. So that's why it's also commanding a large amount of flow. The ANZ isn't too far behind. And notwithstanding a few little things here or there, be it either bad PR or the odd misstatement, as it were, we think from a value perspective, there is enough there to suggest or keep investors quite interested in our point of view. And the fact that its share price hasn't done as well as the other four is also a bit of an opportunity. So traditionally, I'm not an investor in the banks, Phil, I have to say, but if I was going to look at the cheapest one, the numbers are falling ANZ's way, and hence why we're talking about it today.
Okay, you mentioned EV in that answer. Enterprise value. Now, that's one of the top numbers that you've got on Stockopedia. And I remember we talked about this before, or maybe with Chris, and there's a relationship between enterprise value and market cap. Is that the case? And it shows
that's correct.
An important piece of information?
Yeah, so the enterprise value, in its words, the theoretical takeover value, where it looks at obviously the value of the business from a market cap perspective, but then it subtracts the cash on hand and it adds the debt that the company holds. So in effect, cash is pretty portable. So when you're buying a business, yes, normally you'd get the cash, but really it's not yours. Quite frankly, that could just be given out the next day and it doesn't matter. And if you buy a business, you're buying its debt as well. There's no way around it. Once that commitment is transferred over, then it's your commitment to stay, and hence why it has to be part of that takeover value. So enterprise value in its most purest form is somewhat a bit of a takeover value, assuming that the market cap was actually correct, or that the base level of the value of capital was at the correct amount to start with. And to then determine that, you then need to do a whole range of spreadsheet jumping around. And to be quite frank, I'm not going to bore you to snores with the detail, Phil, but it can be quite a big and complex process, notwithstanding the announcements look nice and easy to read, of course. So, yeah, I suppose for those that do look at businesses as a general rule, you tend to lean a little bit more on EV because it tends to provide a purer picture, particularly also in that mining space, in those little penny dreadful miners, where effectively you are looking for a business whereby it has a small EV because its cash balance is large, so it's got a few months to last a little longer. But obviously in these sorts of businesses, it takes a very different perspective in regards to EV, particularly when you're deposit and also lending out institution. But someone like an ANZ being cheaper than the rest, again, it's just one of those basic metrics you can't ignore at the moment.
So the outlook, I guess the outlook for the bank is the outlook for Australia as at large for us patriotic Aussies.
Look, I think you're right. I mean, I think you'd be hard-pressed to find anyone, Phil, that would tell you that the banks haven't run too hard. I sort of alluded to the fact that prices tend to move between over-enthusiasm and over-pessimism, when in reality, probably it needs to be somewhere in between. I think it's fair to suggest that at the moment we're at over-optimism, be it either CBA or ANZ in this case, of course, Westpac, NAB, all of those have had pretty good runs over the last 12 months and is trading at 52-week highs. So they're definitely nothing to be sneezed at and have been doing well. The increased competition that we've been hearing about that's been impacting net interest margins, as it were, in my view, it tends to be a good sign because it shows that there is continued strength and support in the sector. And let's face it, when it comes to these big four, the majority of their earnings do actually come from the loans that they issue out and having those long-dated loans and the interest repayments that they reclaim on them over time. If I was to take an extremely short-term view, I would tend to agree with regards to what the analysts would say. Probably in the zig and zag, we're zigging at the moment and are probably coming closer to the top of that. In fact, every up day brings you closer to the next down day. But if I bought these back when they first floated back in, pre-2000 and I'm sitting on some massive capital gains, I ain't necessarily going to be listening to this podcast, Phil, to make a decision as to whether I need to continue holding the bank or not, because it's most likely in that situation going to remain a cornerstone of many investors' portfolios. The golden handcuffs will keep them there for one, but even outside of that, there is that overall view on the Australian economy, which from my perspective, I tend to think, and we know that there's a strong underlying demand for properties and housing coming through. This is a bit of a top of the cycle perspective. They did fall a hell of a lot during COVID because, of course, the banks did as much as they could to ensure that everyone's loans weren't being recalled, that there was no property crash, and they ensured that basically we were able to ride through this short-term squeeze, but it doesn't mean their prices can't fall in the future. But I'll be damned, Phil, if this nation gets any smaller, as I said, over now compared to the next decade coming. And if you take that perspective, then you've got to be exposed to a bank, or at least a broad ETF or fund strategy where there is at least a large exposure to them. Because, of course, just because they're big doesn't mean they'll always be big. But when you have such a basic, simple business model, in my view anyway, and that commands such a large part of your overall earnings, you'd be remiss if you actually ignored it altogether. So ANZ, yes, you're right. I'm long the Australian economy. I'm sure they'll have the rocket scientists and the brainiacs to figure out where the next opportunity comes from, or they'll just copy what the other guy does. It doesn't really matter. But in our view, because it is the cheapest of the big four at the moment, and if you have to have a big bank exposure, then it's one to seriously consider at the moment.
Fantastic. Elio D'Amato, thanks very much for your time today.
You're welcome, Phil. Not a problem.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.